But still, there's still an element of buying a piece of an option that might be in the money only in particular situations. So we've seen that one could say there's two types of DVA. The cash DVA is associated with pure funding instruments such as debt liabilities, while derivative DVA is more associated with kind of potentially being into a liability state. So contingent funding instrument. Why funding? Well, you could see the funding element here by considering that apart from other hedges, a bank that deals with say a corporate client on an uncollateralized line will typically hedge the position or will replicate the position in the market on a collateralized line where collateral is exchanged. So situations where the dealer is out of the money with the corporate client is a situation where it's actually in the money with the hedge provider. And being in the money with the hedge provider on a collateralized lines means that there's collateral coming in on that other side. And so net-net, the dealer has collateral, possibly cash, coming from the hedge provider, which is still a source of liquidity. On the other hand, they don't have to, they can pay back later this negative exposure to the corporate client. So it's still a kind of source of funding. We'll talk about this more in detail later, but this is a very simple way in which one can see how this is a contingent funding exercise. So typically, even if the bank, or even if it's not a bank that deals in derivatives, the treasury of a business holds a stock of cash DVA. They issue bonds or loans, let's say, and they buy some cash DVA, while the CVA desk takes on, let's say, the stock of derivative DVA, so the DVA that comes from these contingent funding exercises that are bilateral derivatives. So one way that one can see the CVA hedging, the CVA desk hedging this type of sensitivity and this type of negative theta is by selling some cash DVA to the treasury. So let's see how this can actually work with a simple diagram. So there's a kind of DVA stock in a bank where the treasury holds most of it, which is the cash DVA that is linked to the funding exercise, to the leverage exercise, access to funding liquidity, paying DVA to receive money up front in exchange for a credit risky bond obligation. On the other hand, the CVA desk is not really involved in this type of leverage exercise, but on the other hand, they will hold, together with the CVA, they will hold a stock of DVA, of derivative DVA, which is, let's say, the counterpart, the other side of the counterparty risk seen by counterparties. So what one can do is saying the CVA desk will sell, let's say, in exchange for this contingent liability, the CVA desk, at least in some operational setups, is allowed to sell cash DVA to the treasury. So in practice, it's like the CVA desk is allowed to lend money to the treasury with kind of internal liabilities within the bank, which are valued in the same way as the liability, the actual liability of the bank. So in this way, it's a kind of linearization of the derivative DVA, where cash DVA is not contingent. I mean, the notional of the funding exercise is not contingent, is fixed, which is the characteristic of the cash DVA. At the same time, the CVA desk can concentrate on hedging the very complex hybrid risks that come from both CVA and DVA, and they don't have to worry about considering the hedge of own credit spread risk as a particular chapter in itself. So they basically push it back towards the Treasury, and the Treasury has a view of, let's say, all the cash DVA that the bank has. So it's a way of centralizing this linearized version of the derivative DVA. And this can be achieved with internal liability instrument within a financial organization, for instance.